Traders War Room proudly presents the daily video with the best trading and investing alerts anywhere on any platform. With up-to-date stock, chart, and market news, TWR is simply your one-stop shop. TWR Tech video. Stay tuned at the end for TWR Hot Products and Services. Tonight, we're going to talk about what is an economic bubble, how does it work, and I'm going to give you some examples of previous bubbles. So a bubble is an economic cycle that is characterized by a rapid escalation of the market value, particularly in the price of assets. This fast inflation is followed by quick decreases in value or contraction that is sometimes referred to as a crash or a bubble burst. Typically, a bubble is created by a surge in asset prices that is driven by exuberant market behavior. Now, during a bubble, assets typically trade at a price or within a price range that greatly exceeds the asset's intrinsic value. The price does not align with the fundamentals of the asset. The cause of bubbles is disputed by economists. Some economists even disagree that bubbles occur at all on the basis that asset prices frequently deviate from their intrinsic value. However, bubbles are usually only identified and studied in retrospect after a massive drop in price action occurs. And that is basically the stock market's hindsight being 2020. So let's talk about how bubbles work. So an economic bubble occurs anytime that the price of goods rises far above the item's real value. Bubbles are typically attributed to a change in the investor's behavior, although what causes this change in behavior is debated. Bubbles in equity markets and economies cause resources to be transferred to areas of rapid growth. At the end of a bubble, resources are moved again, causing the price to deflate. Simply put, this is the market's rotation of money, following what's hot and selling what's not. Now, the Japanese economy experienced a bubble in the 1980s after the country's banks were partially deregulated. This caused a huge surge in the price of real estate and stock prices. The dot-com boom is another example, also called the dot-com bubble, was a stock market bubble in the late 1990s, and it was characterized by excessive speculation on internet-related companies. During this dot-com boom, people bought technology stocks at high prices, believing they could sell them at even higher prices until confidence was lost and then the market correction occurred. The research of American economist Hyman P. Minsky helps to explain the development of financial instability and provides one explanation of the characteristics of a financial crisis. Though in research, Minsky identified 5 stages in a typical credit cycle. While in theory went largely under the radar for many decades, the subprime mortgage crisis of 2008 renewed interest in his formations, which also helped to explain some of the patterns of a bubble. His bubble theory is used today across the globe in all markets. So the first stage of an economic bubble is displacement. Displacement occurs when the investor gets enamored by a new paradigm, such as an innovating technology or interest rates that are historically low. A classic example of displacement is the decline in the federal funds rate from 6.5% in July 2000 to 1.2% in June of 2003. Over this 3-year period, the interest rate on a 30-year fixed-rate mortgage fell by 2.5 percentage points to a then historic low of 5.23%, and this was sowing the seeds of the subsequent housing bubble. The next phase is the boom phase. This is where prices rise slowly at first following displacement, but then gain momentum as more and more participants enter the market, setting the stage for the boom phase. And during this phase, the asset in question attracts widespread media coverage. Fear of missing out on what could be a once-in-a-lifetime opportunity spurs more speculation and draws an increasing number of investors and traders into this fold. Sound familiar? Maybe like a GME or AMC bubble? Or maybe even closer to home currently, NVDA and the AI bubble revolution. The third stage is the euphoria stage. Now, during this phase, caution is thrown to the wind and asset prices skyrocket, okay? Valuations reach extreme levels during this phase as new valuation measures and matrices are touched to justify and the relentless rise and create greater fool theory. The idea that no matter how prices go, there will always be a market of buyers willing to pay more and plays out everywhere. For example, at the peak of the Japanese real estate bubble in 1989, prime office space in Tokyo sold for as much as $139,000 per square foot. Similarly to the height of the internet bubble in March of 2000, commercial and a bunch of technology stocks on the Nasdaq grew greater than the GDP of most nations. This is also the highest risk taken area on this particular cycle. The next phase is the profit-taking phase, and this is where the smart money is heeding the warning signs that the bubble is about at a bursting point, and they start to sell their positions and take profits. By estimating the exact time when a bubble is due to collapse, it can be difficult exercise because, as an economist John Maynard Keynes put it, the markets may stay irrational longer than you can stay solvent. In August 2007, for example, French bank BNP halted withdrawals from 3 investment funds with substantial exposure to the U.S. subprime mortgages because it could not value its holdings. Now, have we seen this lately from big money? Talking about maybe taking some profits on Apple, Microsoft, or NVDA? The fifth and final stage of this cycle is the panic cycle, and it only takes a relatively minor event to prick a bubble, but once it's pricked, the bubble cannot inflate again. So in this panic stage, asset prices reverse course and descend as rapidly as they have ascended. Investors and spectators, faced with margin calls and plunging values of their holding, now want to liquidate at any price. As supply overwhelms demand, asset prices slide sharply. Think just a few months ago about Meta, Tesla, and chip stocks dumping like 60, 70, 80% and how they've rebounded here recently. One of the most vivid examples of global panic in the financial markets occurred in October 2008, weeks after the Lehman Brothers declared bankruptcy and Fannie Mae, Freddie Mac, and the AIG almost collapsed. The S&P plunged almost 17% that month, and it's its 9th worst monthly performance ever. Now, let's talk about some examples of bubbles. Recent history includes 2 very consequential bubbles, the dot-com bubble of the 1990s and the housing bubble of the 2007 and 08 area. However, the first recorded speculative bubble, which occurred in Holland, was in 1634 to 1637, and this provides an illustrative lesson that applies to the modern-day markets. Tulip mania. Now, while it may seem absurd to suggest that a flower could bring down a whole economy, that is exactly what happened in Holland in the early 1600s. The tulip bulb trade initially started by accident. A botanist brought tulip bulbs from Constantinople and planted them for its own scientific research. Neighbors then stole the bulbs and began selling them, and the wealthy began to look at it as rare varieties and luxuries. As their demand increased, the price of bulbs surged. Some rare varieties of tulips commanded astronomical prices. Bulbs were traded for anything with a store of value, including homes and acreage. At its peak, tulip mania had created such a frenzy that fortunes were made overnight. And you can see the chart up there that kind of gives you an interpretation of the rise and the fall of the tulip mania. The creation of a future exchange where tulips were bought and sold through contracts with no actual delivery fueled the speculative pricing. The bubble burst when a seller arranged a big purchase with a buyer and the buyer failed to show. At that point, it was clear that the price increases were unsustainable. Of course, this created a panic that spiraled throughout Europe, driving the worth of any tulip bulb down to a tiny fraction of its recent price. Dutch authorities stepped in to calm the panic by allowing contract holders to be freed from the contracts for 10% of the contract value. In the end, fortunes were lost by noblemen and laymen alike. And as you can see from the chart, it of course followed the cycles of a bubble typically that we know today, with the normal rise and fall and all of the characteristics that are associated with the economic cycle of bubbles. Now, one that a lot of us will probably remember, let's talk about the dot-com bubble. The dot-com bubble was characterized by a rise in equity markets that was fueled by investments in internet and technology-based companies. It grew out of a combination of speculative investing and the overabundance of venture capital going into startup companies. Sound familiar? Investors started to pour money into the internet startups in the 1990s with the express hope that they would be profitable. As technology advanced and the internet started to become commercialized, startup companies in the internet and technology sector helped fuel the surge in the stock market that began in 1995. The subsequent bubble was formed by cheap money and easy capital. Many of these companies barely generated any profits or even a significant product. Regardless, they were able to offer initial public offerings. We've seen SPACs do this as well, and Lucid definitely comes to mind. The stock prices saw incredible highs, creating a frenzy among investors, but the market peaked. Panic among investors ensued, and this led to about 10% loss in the stock market. The capital that was once easy to obtain started to dry up. Companies with millions in market capitalization became worthless in a very short amount of time, and as the year 2001 ended, a good portion of the public dot-com companies had folded. Now, we have not quite seen this in AI yet, but think about the EV market and all of the startups that happened with the EV boom that was supposed to happen that really didn't fizzle out. It hit hard, and then look at all these that came back. A good example, Tesla came down and it's come back, but it was the first, right? So it's kind of the king. What about Neo? What about Lucid? What about some of these other ones, okay? So definitely, it hasn't happened in the AI yet. We haven't seen that IPO boom associated with these AI companies. Now let's talk about the housing bubble. The U.S. housing bubble was a real estate bubble that affected more than half of the United States in the mid-2000s. It was partially the result of the dot-com bubble, and as the markets began to crash, values in real estate started to rise. At the same time, the demand for home ownership started to grow at almost alarming levels. Interest rates started to decline, and a concurrent force was the lenient approach on the lenders. That meant that almost anyone could become a homeowner. You get a loan, they get a loan, everyone got a loan. Banks reduced their requirements to borrow and started to lower their interest rates. And the adjustable rate mortgage became a favorite with low introductory rate and refinancing options within 3 to 5 years. Many people started to buy homes, and some people flipped them for profits. But when the stock market began to rise again, interest rates also rose as well. And the homeowners with the arms on their mortgages started to refinance at higher levels. The value of these homes took a massive nosedive, which triggered a sell-off in the mortgage rate-backed securities, or the MBSs. And this eventually led to the environment that resulted in millions of dollars in mortgage default. Now, I'm going to give you an example of a stock that is a classic example of a bubble, but not a sector bubble necessarily, but a stock bubble that was associated with a market bubble. The internet bubble around the turn of the 21st century was especially a dramatic one. Numerous internet-related companies made their public debut in spectacular fashion in the late 1990s before disappearing into oblivion by 2002. The story of eToys illustrates how the stages of a stock bubble typically play out. So let's look at displacement. In May 1999, the internet revolution in full swing, and eToys had a very successful IPO, where shares at $20 each escalated to 78 on their very first day of trading. The company was less than 3 years old at that point and had grown sales to $30 million for the year ending in March 31, 1999, and that was from $0.7 million in the preceding year. Investors were very enthusiastic about the stock's prospects, with the general thinking that because most of toy buyers would buy toys online rather than at retail stores such as Toys R Us, and this was a displacement phrase of the bubble. The boom was while eToys had posted a net loss of $28.6 million on revenues of $30 million in its most recent fiscal years, investors were expecting the financial situation of the firm to take a turn for the best. This also created the euphoria, and by the time the markets closed on May 20th, eToys sported a price sales valuation that was largely exceeding that of rival Toys R Us, which had a stronger balance sheet. And this was an example of the boom and euphoria stages with a particular company. The take profit stage. Shortly after eToy shares fell sharply on concerns that potential sales by the company insiders could drag down the stock price following the expiry of lockup agreements that placed restrictions on the insider sales. Trading volume was exceptionally heavier that day at 9 times the 3-month daily average. By March of 2000, the company had seen a 70% decline in its stock price from its record high of $84, identifying this as profit-taking phase of this bubble. Now into the panic. So by the end of quarter 1, 2000, the panic stage had arrived, and the company was still spending an extraordinary $2.27 on advertising costs for every dollar of revenue generated. Although the investors were saying that such expenditures were characteristic of the new economy, such as a business model simply is not sustainable. In July of 2000, eToys reported its fiscal first quarter loss widened to $59.5 million from $20.8 million a year earlier, even as sales tripled over this period in $24.9 million. That is a huge margin widening. It added 219,000 new customers during the quarter, but the company was not able to show bottom line profits. By this time, with the ongoing correction in the technology shares, the stock was trading around $5. Towards the end of the year, with losses continuing to mount, eToys would not meet its fiscal third quarter sales forecast and had just 4 months of cash left on the balance sheet. The stock, which had already been caught up in the panic selling of internet-related stocks since March, was also trading around slightly over $1, and it fell 73% to 28 cents by February 2001. Since this company failed to retain a stable stock price of at least $1, it was delisted from the NASDAQ, and a month after it had reduced its workforce by 70%, eToys fired its remaining 300 workers and was forced to declare bankruptcy. By this time, eToys had lost $493 million over the previous 3 years and had $274 million in outstanding debt. What causes asset bubbles? Well, the asset bubbles can begin in any number of ways, and often for sound reasons. Major incubators of bubbles, which often interact or occur in tandem, include interest rates that might be low, which tends to encourage borrowing or spending, expansion, and investing, low interest rates, and other favorable conditions in a nation encouraging an influx of foreign investment and purchasing, new products or technologies which spur demand, and whenever something is in demand, its price naturally rises, what the economists dub pull inflation, and there are shortcomings in assets causing the cost to climb in a classic supply and demand principles. Now, so far, so good, right? These are solid factors for appreciation. However, a problem arises when an asset bubble begins the snowball effect to feed on itself and to swell out the portion of the fundamentals or the intrinsic worth of the assets involved. Opportunistic investors and speculators are plunging in and pushing prices up even more. And why are they all doing this? It has to do with nothing with fundamentals, but human fables, the psychology of often irrational thinking and actions about money, known as behavioral finance, or as we like to call it, FOMO and YOLO. Now, going more into the behavioral finances, right? These include things like the herd mentality, doing something because everyone else is doing it, short term thinking, just looking at the immediate returns or thinking you can beat the market and time a quick exit, and the cognitive dissonance, only accepting information that confirms an already held belief and ignoring anything that doesn't. So, what happens when an asset bubble bursts? Well, a range of things can happen when an asset bubble finally bursts, as it always does eventually. Sometimes the effect can be small, causing losses to only a few and or short-lived, but other times it can trigger a stock market crash and general economic recession or even a depression. Now, much of this depends on how big the bubble is, whether it involves relatively small or specialized asset class versus a significant sector like, say, tech stocks or residential real estate. And of course, how much invested money is involved. Another factor to what degree debt is involved in inflating the bubble. A major 2015 research study, Leveraged Bubbles, examines asset bubbles in 17 countries dated back to the 1870s. Now, what this research did, it categorized them into four types, but along two basic lines, and it was all based on credit, that is, how funded investments were financing and borrowing. The study found that the more credit involved, the more damaging the bubbles pop. Debt fueled equity bubbles led to longer lived recessions. Even worse were leveraged housing bubbles, like the one that popped in '06 and '07, leading to the subprime mortgage crisis that kicked off the Great Recession. But seriously, now, let's talk about what an indicator of economic bubbles. And this one's tricky because bubbles, they're hard to spot while you're in one. And it's only when you're done with it in hindsight, after they burst, do they really become clear. But they have characteristics that are seen in previous bubble. First of all, excitement around the new thing happens. Evaluations that are far exceeding their intrinsic value, and you see a lot of rotation of big money primarily into one sector or a few similar stocks. So one such one was the dot-com bubble that we were talking about. And it was a rapid rise of the U.S. technology stocks, and especially in the novel internet-based companies that helped lift the stock markets in general. The tech-dominated NASDAQ index quadrupled in value from under 1,000 to more than 5,000 between 95 and 2000. And unfortunately, when many of the new hot tech companies failed to turn a profit or perform up to their expectations, the investors soured on them. And in 2001 and 2002, the bubble popped. In the ensuing crash of the NASDAQ fell over 75%, and stocks in general entered into a bear market. Now, before we finish up, I want to explain what a bubble is in the finance terms, right? So, a financial bubble is also known as an economic bubble or an asset bubble, and it's characterized by a fast, large climb in the market price of different assets. This rapid growth, though, is relatively short-lived, like bursting of a bubble, and it abruptly reverses course, dragging asset prices down with it, sometimes even lower than their original levels, creating a new low. Typically, a bubble is created out of sound fundamentals, but eventually exuberant, irrational behavior that takes over, and the surge is caused by speculation buying for the sake of buying in hopes of a continued rise. All right, so that's all I got for you. So, in conclusion, a rapid price rise, high trading volume, and word of mouth spread are the hallmark signs of typical bubbles. If you learn of an investment opportunity with dreams of usually high profits from social media or friends, you should be particularly wary because in most cases you will need uncanny timing to come out ahead. Experts have concluded that speculative bubbles in some assets are inevitably on all market economies. They just happen. However, though, Becoming familiar with the steps involved in bubble formation may help you spot the next one and avoid becoming an unwitting participant in it. TWR is here to bring together the like-minded traders and investors so that you are not alone in your trading journey. So be ready to ride the wave, attack the trend, and destroy the market. And as always, let's go to war together. Upcoming events. Our next class is set, guys. On 11 June at 1 p.m. Central Standard Time, TWR is going to teach you Sports Betting 101, how to pick and bet the winners from the losers. Our instructor, Tech Bets, is the best analyst you've never heard of. He's the total package, guys. He has a great win percentage, great picks, and great knowledge. And he's only on TWR. He's going to teach you the basics and the strategy that makes bank betting on live sports. So, sign up today right there at traderswarroom.com/upcoming classes. And as always, the link is in the description. I will see you there. And then we got a new flyer. Of course, it looks different than the last one. But following that class on 25 June, we got the TWR Gap Trading 101. I'm going to teach you guys how to destroy gaps to destroy the market. This is going to happen 25 June at 1 p.m. Central Standard Time. $15 gets you a seat, and everybody gets the recording. Of course, same thing like the last class. traderswarroom.com/upcoming classes. You can sign up right there, and that link is in the description. Traders War Room is your one-stop shop. Try our TWR one-to-one mentoring. Does the market have you feeling like this? Or wanting to rip your hair out while you watch your account dwindle? If that's you, then Traders War Room has you covered. Our one-to-ones focus on you as a trader or investor. The Zoom session connects you with a TWR professional. Whether we're covering charts, developing a plan of attack, or being strategic and deep diving on the how, why, and execution of trade plans. TWR one-to-ones will give you the confidence to attack, conquer, destroy, and make the market bend the knee in 2023. Join TWR and bow to no one. Book your session today. The link is in the description or on the website at traderswarroom.com. Let's go to war. Activate your 2-day trial of TWR All Access on the Discord platform. We cover it all at Traders War Room, whether you're looking for stocks, options, futures, Forex, crypto, or even sports betting, or you want real-time alerts, live trading, algo signals, or even if you just want to be part of a community of like-minded investors to grow, learn, and share together as a team. Something for everyone, every budget, and every style. Join TWR today and trade with the bulls. The market is our war zone and stocks are the battle. Join TWR and let's go to war.